Okay guys, today we're making a video on how to not pay taxes on your investments. So I know that that might sound like a wild idea that you can avoid taxes in investing, but it's true. Take for example, AMZA. This is a pipeline ETF. This fund pays a 9% dividend, well 7.84 currently. I locked it in at 9%. And it's an MLP, so it does not report its taxes the same way to the IRS. So if you don't sell your position in AMZA ever, and you just collect your dividends like we do monthly, we never pay any taxes. It's listed as return of capital. That's what it's classed as, return of capital. So AMZA, we're up 13% on. As long as we don't take this gain, we don't pay any taxes. So there are two other techniques you can use, okay? I'll get into them throughout the video. The second technique you can use is to simply buy Cornerstone, one of my favorite funds on this channel. Cornerstone has a return of capital aspect too, just like AMZA. While AMZA is full return of capital and you don't get paid tax on any gains unless you sell, Cornerstone, it's a portion of return of capital. Just know that return of capital means you don't have to pay taxes, and this fund, Cornerstone, gives you a portion of return of capital, so you don't have to pay all your taxes through Cornerstone. All right, the other factor about return of capital, very briefly, people are against return of capital. They think it's just returning your own money to you, but when it's accretive to the NAV, then it's a good thing. So Cornerstone's ROC is constructive because it's accretive to NAV, to the net asset value. Again, don't worry about what it means. Go look it up yourself, net asset value. But as long as the net asset value is growing, then return of capital is good. If net asset value is falling, then return of capital is just a waste and it's a return of your own money. These can still be used to your advantage. If you have a return of capital vehicle that's going down in price, but you're receiving a dividend, 10% dividend, let's say, over the course of 10 years. Well, even if it's going down and returning your own money to you, after 10 years, that is pure cash flow. So a lot of dividend nuts will go find anything that pays a dividend over 10%, even if it's return of capital, even if it has poor returns performance-wise in the market, because they know that they're playing the cash flow game. They're playing the 10-year rule with cash flow, and it's 100% profit after that. So the first way to not have to pay taxes through investing is AMZA. That's one vehicle. It's a pipeline ETF that is a master limited partnership that's structured in a way that has to pay out all of their dividends to investors, mostly all their dividends, if not all, 90% to 100%. And that gives them favorable tax structure to the IRS, and that makes it to where you don't have to pay taxes on your investment if you don't sell, as long as you don't sell. Many people hold things like AMZA until they die, and they bequeath them to their children. And then the next way is by just buying the S&P like we do with Cornerstone funds, but it's structured in a way, Cornerstone, to where you don't have to pay the taxes like people have to pay on SPY or the S&P 500. And know that even though they kind of go sideways and people think it's poor return of capital and it's degrading to your portfolio, look at our performance. We're up 30% for the year versus the S&P up 6 and the NASDAQ up 12. So this is all mainly because of Cornerstone. And we don't have to pay taxes through Cornerstone, or all of our taxes through Cornerstone. So that's a major advantage. So AMZA pipelines, you don't have to pay any taxes if you don't sell. Cornerstone, it's a portion, okay? Plus it's the index. So it's the way you play the index without getting burned on regular stocks. You can put all your money in a Cornerstone. You get all your money behind it. You get major days gains, plus you get yearly dividends. Because on 400,000 days gains, if the market's up 1% like it will be today when it opens, then that 400,000 should be worth about 4,000. 400,000 times 1%, 4,000. So you get the up participation with the market in days gains format, and you get dividends. So 95,000 a year in dividends, plus today could be a $4,000 to $10,000 day. We'll see. This is what big business does, and they structure their rules and tax codes in a way that makes them win. So you do that with AMZA. I told you, pipeline, that's one way. And then you can do it with a Cornerstone fund. It's like the S&P, but you're playing it in a more sophisticated way, I believe. Plus, Cornerstone beat the S&P over the last 10 years. If you watch our past videos of Cornerstone on our channel, you'll see all the advantages that it has. But this video, we're just going to highlight the brief fact that it's also has tax advantages. So the third thing you can do to beat taxes really quickly is you can just rebalance. You don't have to sell all of your gains. So the other day you saw a video, we're up in Fangu. We have 2,000 in Fangu here. We were up 2,400 the other day. So we just simply trimmed back $400 worth, and we kept our gain in there. We don't have to pay taxes on this gain for Fangu because we only took a small amount of it as we trimmed it. We didn't sell the whole thing. You just trim it like a plant. You prune and trim. So rebalance and trim your positions every quarter. When they have big runs, trim them. It's also a good way to manage risk. So when it falls, you don't lose the whole position that you're in. Like if Fangu, we had 4,000 in at one point. We've been trimming it and trimming and trimming. If we left it at 4,000 from our $2,000 core, 4,000, you fall 10%, now you're down $400. But if you fall 10% on your core of 2,000, you're only down 200. So you minimize your risk when you trim and rebalance, as well as you avoid paying hefty tax gains. You only pay a portion as you only trim a portion. So that's the third way. The fourth way people like to beat taxes is to go market to market, but we're not mark to market. We're not doing that here because that implies that, yes, when you're losing big on paper, you don't have to pay taxes on that. That's great. Traders like to use this to their advantage. But if you're winning big on paper, then you have to pay taxes on that. So mark to market implies that you'll never be successful. And if you are, then you have to pay huge taxes on that. So I don't like the mark to market strategy. I'd rather just not lose. I'd rather not be risky. I'd rather just stick with these names that you see that give me return of capital and tax advantages already. And then the last thing I want to say is to simply just go long term on your funds, because if you go long term, you get taxed at 15%, not at the traditional tax rate of 20 or 30% or wherever it is for ordinary income. I forgot the numbers on ordinary income because I don't pay attention to them. I'm not beholden to them anymore. I just collect my dividends. Most of them are tax-free or have a portion of tax advantages, and I trim and rebalance my positions regularly so I don't have to pay the full amount of taxes. I don't worry about mark to market. And then when I go long term, it changes my tax structure considerably to 15% long term capital gains tax rules. So you're only paying 15% on these funds if you hold them for over a year. So that's what I do. And when you hold dividends, you want to hold them for over a year anyway because you're in it for the long haul. You're trying to collect dividends. So I hope you enjoyed this video. Stay tuned for further videos today. Thanks.